Hello everyone, I'm Ankit and you're watching StudyIQ IAS English. Now, whenever we have to keep certain money safe, we usually deposit them in our bank accounts. Well, this is what our parents have taught us, that to keep the money safe, away from theft, away from any evil eyes, you deposit them in the banks, right? Now, have you ever considered a scenario? What if the bank where you have kept your hard-earned money, where you have saved your entire life savings, what if the bank goes out of business? What if there is a theft in the bank? Is in that case, will you get any money back? Well, yes, you'll get the money back. So how much money are you eligible to get it back? This is what we are going to cover in our today's video. Now, the notes which I will be using in our today's session, in case if you want to download them, you can go to a particular Telegram channel called as ATS Live. And while you're at it, downloading the notes, please do not forget to subscribe to the channel also. So let us understand the scenario. What happens in case a customer makes a deposit in a bank, right? So this is a bank, let us say, and what do customers like you and I do? Customers like you and I, we make a deposit in the bank accounts, right? So customers, they make deposits in the bank account. Now, what if this bank in which you have kept your hard-earned deposit goes out of business? Have you considered this scenario ever? Will you get your money back? And yes, if you'll get your money back, how much money you will get it back? To understand this, we need to first of all understand how the concept of insurance actually works. Now, let us suppose you want a health insurance, right? Many of us, what if we face a health related issue in the future? And if we visit a hospital, you all understand how long the bill a hospital can generate, especially if it is a private hospital. So how will you minimize your financial risk? You buy a health insurance product. For example, if you go to a health insurance company like HDFC Ergo, they'll offer you multiple plans. They'll offer you health insurance coverage for 5 lakhs, 10 lakhs, 15 lakhs and such kind of amounts. Now, let us imagine you buy a 10 lakh health insurance cover. What is this 10 lakh health insurance cover? In a year, if you need any hospitalization, up to 10 lakh rupees, the bill will be paid by your insurance service provider, which in this case is HDFC Ergo. Similar with 5 lakh and 15 lakhs, your bill will be covered up till a certain amount of money. Now, to buy this policy, to subscribe this policy, you need to pay some amount of money. What is this sum amount of money called? This sum amount of money in insurance language, it is called as a premium. What is a premium? You pay some amount of money, and with this some amount of money, you're eligible for a particular health insurance policy. If you need, God forbid, any kind of a hospitalization, they will take care of your bills up till a certain amount. Now, what about this premium amount of money? Will you get this back in case if you don't use your health insurance at all in the period of 1 year? Well, the answer is no. To understand how this premium actually works, we need to borrow another example. Well, all of us usually watch Netflix. To watch Netflix, you need to pay them some amount of money, which is called as a subscription. Let us suppose you pay Netflix every month 649 rupees. Against this 649 rupees, which you have paid as subscription, Netflix offer you access to all their contents in the highest possible, that is 4K resolution. So this is the benefit of a subscription, that if you want to watch 1 movie in a month, if you want to watch 5 movies in a month, if you want to watch 50 movies in a month, all you need to pay is some amount of subscription fees and Netflix will take care of the rest. But what if you don't watch any movie, any TV show in that 1 month period of your subscription? Will Netflix refund you the 649 rupees back? The answer is no. Similarly, if you buy a health insurance product or any insurance product and you pay a premium for that product, you are not going to get your premium back in case if you don't use your money at all. But what if you need health insurance or if you need health care bills, right? All of those bills up to 10 lakh rupees will be settled by your health insurance provider in case if you have paid a premium. For example, for a 10 lakh rupees health insurance, you need to pay a premium of around 15,000 rupees. So you have taken care of your risk that by paying 15,000 rupees of your premium, your insurance provider will settle bills of around 10 lakh rupees. So this is how insurance generally works. Now let us come back to our discussion. I told you, right? If you need certain kind of protection, or if your bank's deposit needs certain kind of protection, there is this company called as DICGC, Deposit Insurance and Credit Guarantee Corporation, which offers banks deposit the insurance that they need. What is DICGC? DICGC, or Deposit Insurance Credit Guarantee Corporation, is a 100% owned subsidiary of the RBI. It is 100% owned by RBI. What is the nature of this body? This is a statutory body, and it gets its powers from an act passed by Indian Parliament, that is Deposit Insurance and Credit Guarantee Corporation Act of 1961. Now, who heads this body? This body is headed by a deputy governor of RBI. Now, what is the authorized capital of this body? The authorized capital of this body is rupees 50 crores. Right now, this is the body, Deposit Insurance Credit Guarantee Corporation, that provides the service of deposit insurance to all the banks in India. Now, to get this service of deposit insurance, you understand, the banks would have to pay something. What would banks pay? Banks would pay premium to DICGC, right? Now, the next question that might come to you, in case if your bank goes out of the business, when will you get your money back, right? Let us understand this. Now, this deposit insurance earlier used to mean that if your banks is going liquidation, or if your banks is undertaken by another company, that is, it is merging with another company, then after this procedure is complete, then you will get your money back. But there was an amendment to this act, DICGC Act of 1961 in 2021, and this 2021 amendment provided that you will get your money back during 90 days of your banks being put under moratorium. What is a moratorium? Moratorium is temporary suspension of any business which is done by the bank. So if a bank is placed under moratorium, who places the bank under moratorium? RBI places the bank under moratorium. And if your bank is placed under moratorium, banks would not accept any new deposits, banks would not give your deposits back, banks would not extend any loans, etc., etc. So it would stop functioning for a temporary period of time until unless liquidation and merger happens. And this is the decision of RBI to place any bank which is under financial stress in moratorium. So you will now get your money back during or maximum 90 days from the time your bank is placed under moratorium. Understood? Now let us understand which all banks are eligible to have their deposits insured by Deposit Insurance and Credit Guarantee Corporations. Here, all banks in India are eligible for deposits insurance. What are all banks in India? They include scheduled commercial banks, they include local area banks, they include payment banks. Have you heard of Airtel Payment Banks? This is one of the payment banks. Similarly, small finance banks and cooperative banks, all of the deposits in these kind of banks are protected from the deposit insurance that is given by the Deposit Insurance Credit Guarantee Corporation. Now you must be thinking, there are few NBFCs in India where you make deposits. Are deposits in NBFC covered under this deposit insurance? The answer is no. Deposits in deposit-taking NBFCs, they are not covered as per the provisions of Deposit Insurance and Credit Guarantee Corporations. Understood? Now the next question is, what kind of deposits are safe in case if your banks go out of business? Now we make multiple different types of deposits in savings account, in current account. We also have time deposits like fixed deposits and recurring deposits. All these kind of deposits are protected by the deposit insurance given by the Deposit Insurance Credit Guarantee Corporation. Now the next question is, which kind of customer is protected in case of the bank goes out of business? Now all customers are protected except few different kind of customers. Now banks also make deposits with each other. So all banks or all interbank deposits are not eligible for protection. Similarly, deposits made by central government or deposits made by any of the state government in banks in India, they are not protected against the failure that usually all the customers like you and I or businesses usually get from the banks. Right? So these are multiple questions that we have understood, that all customers are protected. All of their accounts are protected. Now the next question that might arise in your mind, what is the protection covered offered by Deposit Insurance Credit Guarantee Corporation? The answer to this curiosity is all deposits up to 5 lakh rupees is covered. Now, what is the meaning of this question? Let us understand this scenario in great detail. Now, let us suppose there is this person XYZ who has opened 4 accounts in one particular bank in SBI in one branch itself. Right? So, this is one scenario. Let us suppose XYZ has 4 different accounts. In the first account, this person has deposited 2 lakh rupees. In the second account, in the same branch, this person has deposited 3 lakh rupees. In the third bank account in the same branch, this person has deposited 5 lakh rupees. And in the fourth account, in the same branch, this person has deposited 4 lakh rupees. So what if this particular SBI bank goes out of business? How much money this person XYZ will get back from DICGC in case this banks fail, right? This is a normal question. Now you need to understand the total amount of money XYZ will get is rupees 5 lakhs. Irrespective of the number of accounts you have in a bank, in a particular branch, all of this money, the maximum you are going to get is only rupees 5 lakh. Understood? Now let us understand another scenario. XYZ opens 4 different accounts in SBI but in different branches, right? So suppose in city A, this person goes to SBI, opens a bank account and deposits 2 lakhs. In city B, in different bank account in SBI, he has deposited 3 lakh. In city C, in different bank account, he has deposited 5 lakh. And in city D, this person deposits 4 lakh, right? So all of them are kept in one single bank, that is SBI, but in different bank branches. In this case, how much money will you get back? You will get back again maximum of 5 lakh rupees, because DICGC ensures a customer is getting protected for rupees maximum of 5 lakh per customer per bank. So irrespective of the number of accounts you have, irrespective of the number of branches you have opened your account, the maximum a person would get from a bank is rupees 5 lakhs. Understood? Now let us understand 2 more different scenarios. What if this person XYZ opens 4 accounts in 4 different banks? So for example, if suppose XYZ goes to SBI, opens a bank account and deposits 2 lakh rupees. He goes to Punjab National Bank, opens an account and deposits 3 lakh rupees. He goes to a private sector bank, ICICI, opens an account and deposits 5 lakh rupees. He goes to another private sector bank, HDFC, opens an account and deposits 4 lakh rupees. So what if in a hypothetical scenario, this won't happen ever, don't worry. In a hypothetical scenario, what if all these 4 bank branches fail, or these 4 different banks fail once at a time? How much money you're eligible to get back? You will get back up to 2 lakh rupees from SBI, you will get 3 lakh rupees from PNB, you will get 5 lakh rupees from ICICI, and you will get 4 lakh rupees from HDFC. So in this case, the total amount of money you are going to get back is 14 lakhs. Now you understand why people say that if you have a lot of money, deposit them in different banks. This is the reason why. The reason why, because all these banks would pay premiums individually. And as I told you, based on this formula, the DICGC ensures 5 lakh rupees of deposit insurance per customer per bank. So if you change your bank, you are also eligible for increased deposit insurance. Now let us understand one more scenario. Let us suppose XYZ has opened not 4 but 3 different accounts, and these are different types of accounts. What are different types of accounts? Let us suppose XYZ has opened a personal account in SBI. Personal account, he has deposited 2 lakh rupees. Understood? What if this person opens a joint account with his family member or his friend? In that bank account, let us suppose he has deposited 6 lakh rupees. What if he opens a corporate account or a company account which he is one of the signatories to withdraw the money? That bank, let us suppose, has 5 lakh rupees. So how much of money the person XYZ would get in case if the bank where he has opened these 3 different types of account were to fail? In this case, he will get 2 lakhs from his personal account back. Then he will get 5 lakhs from the joint account back, and he will get 5 lakhs from his corporate account back. So in this case, he is eligible to get 12 lakh rupees back. Why? Because all different types of accounts are eligible for separate deposit insurance, even if they are in the same bank. Understood this part? So what we understand? DICGC offers 5 lakh rupees of deposit insurance per customer, per bank, per type of account. Understood this? Now let us get back to our discussion. Now I told you which type of customers are covered, which different types of accounts are covered, in which banks you'll get the deposit insurance, and when you will get the money back. Now comes the most important and the recently development part. The recent development part, it relates to who pays the premium. I told you it is the bank who pays the premium. Now the next question is, how much premium are the banks paying? Now earlier, the banks used to pay the premium of 0.12% of deposits. So based on this formula, for every 100 rupee deposits in the banks, the bank need to give DICGC 12 paisa as premium. Now this premium that was given by banks was uniform for all the types of banks. It was uniform whether the bank is big, whether the bank is small. So for example, SBI earlier used to pay 12 paisa for every 100 rupee deposit, and even a small bank like Yes Bank would pay the same premium. Now RBI has come up with a recent amendment to how much premium the bank requires to pay, and this is called as risk-based deposit insurance framework. That is risk-based deposit insurance framework. What does this framework include? This framework actually makes the bank pay more or less premium depending upon the financial health of a bank. This deposit premium framework says the maximum premium that the banks are now required to give is 0.12% of the deposits, and the minimum amount of premium the banks are required to pay is 0.08% of their deposits. What does this mean? Now let me give you another example. Suppose if you buy a health insurance, and if you have a bad habit of smoking and drinking alcohol, or if you have certain existing diseases like blood pressure or like diabetes, you are required to pay a higher premium as compared to a person who is physically and health-wise fit. Similarly, a banks would also require to pay different amount of premium depending upon what? Depending upon their financial fitness. So a bank which is very financially healthy, they are required to pay less premium, and the bank which is not financially healthy, they will have to pay the maximum amount of premium, and all banks would be in between this range. So the minimum premium that a bank requires to pay for providing deposits to its customers up to 5 lakh rupees depends upon their financial health. The better the bank, the less the premium they pay, very similar to the insurance policies that we get, right? So what did we understand from our discussion? The premium amount now actually varies bank by bank, and this depends upon the financial health of the bank. The maximum premium the banks pay is 0.12% of deposits, and the minimum amount of premium that the banks are now required to pay is 0.808% of their deposits. And you understand, the financially fit bank is, the less amount of premium they pay. And irrespective of the premium they pay, any customer in the banks are eligible to get protections up to how much amount of rupees? Up to 5 lakh rupees. So the deposit insurance that you get is up to 5 lakh rupees per person per bank account. Understood? So this was all for today's discussion on deposit insurance framework, which has been revised recently to make it risk-based deposit insurance framework. Who has bought in this framework? RBI. Who provides deposit insurance to the bank? Deposit Insurance Credit Guarantee Corporation, which is 100% owned subsidiary of RBI. This body is headed by a deputy governor, and what kind of deposits are protected? All kinds of deposits are protected except interbank deposits and center and state deposits. In which banks these protections are provided? All kinds of banks except obviously NBFCs. Who pays the premium? Banks pay the premium, and it varies depending upon the type of banks. Understood? So this is all for today's discussion. I hope you get all the information you need, and you know, to download the notes, please go to this particular Telegram channel, ATS Live, where I'll just upload this hand annotated notes for you. And in case if you have any doubt, you can email it to me. You can contact me on the Telegram channel. My email ID is ankit.singh1@studyiq.com. Okay. So this is all from my side. Please have a very good night.